All right, you know what? Let's get this meeting started. A shade before 6:30, March 7th. Let's talk about the market, but more importantly, uh, if you have any questions, put them on the chat. The more questions you ask, the better off and more informative this is going to be. So if you have questions, just put them in the chat, whatever it might be. I'm going to make this quick and right to the point. What I'm looking at right here is, let me just make this a little bit smaller. What I'm looking here, I'm looking at the 30-minute charts of the S&P 500, IWM, QQQ, semiconductors, Dow Jones, and the biotech index. And I only look at the 30-minute chart or any intraday charts for that matter on the indices when we are in somewhat of a corrective market. That's when I look at these things because you get a better feel. Things are moving a little bit quicker. And what we have here, what we've had since last month, February 16th to be exact, is a pattern of pretty much lower highs and lower lows. And for those of you in the room, the Stock Twitch room, again, right over here, 2/16/2021, the chatter in regards to stocks and Bitcoins was off the charts. It was unreal. I mean, had you asked me 2 months ago, let's say January of 2021, if this is anything similar to 1999, I would have said no. But after what we've seen over the last month or so, yes, we haven't seen anything like this since 1999. Okay. The amount of people who are talking about stocks, the amount of people who are talking about Bitcoins. I just recently received an email from someone who was onboarding to Zor Capital, and the client received an email saying, sorry for the delay. We just have an influx of new accounts. Okay. So there's so many people talking about stocks. There's so many videos, TikTok videos. There's so much information out there that's just wrong information that is really crazy. People over the last couple of weeks, whatever, if it took them 6 months to make gains, they lost it in the last 2 weeks. Because all they're doing is listening to these people buy the dip, buy the dip, buy the dip, don't sell, don't sell, don't sell. And that might be good advice if you only own the indices, the S&P 500s, the Qs, and the IWM. That's great advice if you have a long-term time frame, since the indices go up over time. But individual stocks, they come and go. Some of them will never come back. Okay. So we had a correction in the S&P 500. It's really not a lot. We're talking about roughly, we corrected, after the rally. I mean, it's only 2.5% from the highs. The Qs were the ones that was hit the most. It was down 10% at one point, and after Friday's rally, it's down 8.5%. So that's doing okay. So that's the momentum stocks, the QQQs, were hit pretty hard versus the SPY, the Dow, and the IWM. As far as individual stocks are concerned, like always, individual stocks, they were crushed. The SPAC names, you name it, crushed. If you take a look at, let's see, all the popular ones, IPOE, this is down from 28 down to here, down 40%. IPOF, $18 down to 12 in a matter of days, 33%. Space pretty much cut in half in the last couple of weeks, down 50%. CCIV, the same thing, cut in half. So individual names, all the hot names that stories behind them, whether it's, Riot, that's down, cut in half. Neo, pretty much also almost cut in half. So individual names have been crushed for the most part. Okay. And that's the reason why just, buying the dip and hoping that these things come back, it's not a good strategy, because some of these stocks will never come back. You got to have some type of some type of exit plan or exit strategy. So looking at the market, here's what normally happens. Here's what normally happens when we have a market that is in a correction. You have all these short-term moving averages, and as you can see here, as far as you can go, they tend to trend for a while. So right now, so they were above all these averages, and then slowly but surely, once they get below it, they get below it. Once you go into a correction, before that correction is over, you normally tend to see an inverse head and shoulders pattern. uh, on the 30-minute chart, you start to see these moving averages. They start to flatten out, and then finally price starts to get above. That's number one. Number two, you also get a chance to see that the ATR, the average true range for the indices, it starts to go down. All right. So right now, the average true range for the QQQs is roughly $10. That is huge. That's pretty high. Normally, you only get that high when you're in a correction. What we want to see is we want to see this roll over. We want to see what we saw back here. Very little volatility, intraday volatility. That's normally the best time when you have swings. As long as this is still rising, the market is still going to have big swings. So we want to see this peter out slowly but surely. Okay. So that's number one. Number two, we want to see this inverse head and shoulders pattern. It doesn't have to happen. This might be the shoulder. This might be the head. We're going to see these moving averages flatten out. And then we're going to see price get back above those levels. And number three, more importantly, then we're going to start seeing more setups. Not only any other, not just any setup, but we're going to start seeing setups that are providing good opportunities where the stops are not that far away. Because as of right now, most of the names that are setting up, the stops are extremely far away. So in a situation like this, more often than not, if you wanted to play a bounce, you're better off buying the indices or some type of ETF. For example, I bought ARK on Friday at 111.61. ARK, it's a concentrated ETF, a lot of momentum names. And this at one point by Friday, it was down roughly 33% in a matter of 13 trading days. Okay. So in a situation like ARK, listen, I believe in whatever it is that she's doing, but I'm a believer on the way down. What normally happens with this ETF, it happens every single time, that it has a tremendous run and people go out there and they chase performance. Okay. They chase performance. And if you look at the dollar volume that came into ARK right over here from December till here, it was outrageous. All these people, for the most part, are right now probably losing money. Okay. And then here on the way down, that's when they exit. And this happens all the time. If you go back and you study the Janus 20 from 1999, same thing happened. If you go back and you do Ken Heepner's, the CMG fund, Ken has a tremendous year in 2007, and money just piles in after an 80% run. Then he has a 48% correction, and money comes out and everyone loses money. You go back to Peter Lynch. Peter Lynch ran the Magellan Fund for roughly, 20, 30 years. His annual return was roughly 29.2%. But then when they did the numbers in-house, internally, the average client only made 7%. And the reason why was because they got out every time he had a downturn. That's exactly when they got out, and they came back in after he had a huge run. So this is the Magellan Fund right over here. This is the way it just works for everyone. Everyone likes to chase performance. It's got to spike higher, get me in. Then look, listen, the bigger the run higher, the bigger the sideways to down action you're going to get that's going to follow it. That's just a fact. That's in any stock, any ETF, any hedge fund. The bigger the move higher, this type of move, the bigger the consolidation, the sideways action that you're going to come into right afterwards. Okay. Nothing goes straight up. So here's what happens. Get me in, get me out, get me in, get me out always at the wrong time. So if you believe in Kathy Wood or any other ETF or money manager, whatever the case may be, you want to pay attention when they're going through a consolidation or they've been in somewhat of a drawdown. Okay, you don't want to wait until after the guy's made a tremendous move or she's made a tremendous move. It's all over the news, and then you want to jump on board because they were up 80% and you actually think they're going to replicate that same performance 6 months later. It just doesn't work that way. Okay, so I bought ARKK, very small with the intentions of buying more. I'm hoping it goes down. I'm hoping it goes to $100 to $90. I'm hoping that they get redemptions and they're forced to sell stock. I can't wait to if that happens. I would like to see their emails that come out in the after hours. I want to see one of these days where they don't buy any stock because it was all redemptions. That may happen, may not happen, but that's what I'm looking for to put more money in. Okay, so right now, in the corrective market, we're in the correction. Not too many stocks have the proper setup. If you wanted to buy the bounce, I always suggest the index ETFs or the semi ETF or the biotech ETF, something that has a group of stocks, okay? Because the previous leaders may not be the future leaders. Maybe Tesla's going to lead again. Maybe Apple's going to lead again. Who knows? But if you look at some of the big ones, Amazon, right? This was, had a big move, but it went sideways. This is no longer a leader for the most part. If you look at, what is it, Facebook, the same exact thing. A lot of these FANG names have been going sideways, but if you buy the actual ETF, the SPY, the QQQs, the IWM, and we do have a bounce, you're guaranteed to participate in that bounce as opposed to buying an individual name that may or may not participate immediately. And after you get that bounce, after you get the bounce in the indices, right? And then they start to go sideways. That's when you start seeing the actual individual setups. All right, let's see here. Do you recommend waiting for ATR to start leveling out before you would start buying, adding to a longer hold? Right. So again, when I'm looking to buy the QQQs or any of the index ETF, number one, I want to buy it on the way down. So the average intra-year decline in the market is roughly 15%. Doesn't matter what's going on. It could be anything. It could be for multiple reasons, but the average intra-year decline is roughly 15%. Okay. Some years is more, some years is less. No one really knows. What I like to do is very simply, I want to buy on the way down. I'm not looking to pick a specific spot where I'm going all in. I'm going to go buy, let's say, for example, if I needed to buy 1,000 shares, I'm going to buy 100. Then I'm going to buy another 50, another 20. I'm not looking to time it perfectly because my intentions is to hold it for the long term. So as far as waiting for it to level out, when it comes to the QQQs, if I'm holding for the long term and it's not a trade, I am not going to wait for that to level out. I'm going to buy on the way down. I want to see flushes. Anytime we get a flush, I want to buy that flush. And usually when you have a correction and the market is really in the correction, you normally get a lot of after hours action when the market closes down, whatever it is, 2%. And then for no reason whatsoever, it gaps down after 4 o'clock. I want to buy those gap downs because that's usually when the triple ETFs, they have to rebalance and things move so quickly that they have to do a lot of selling in the aftermarkets. So that's what I want to do. So if I'm looking for a long-term hold in the indices, I'm not going to wait for that to level out. I'm going to buy slowly but surely because my time frame is long. Thoughts on the XSOXL? Right. So this one just did a split 15-1. Right. So look, let's just look at it. 15 it's down. At one point, this thing was down 42%. Which is not bad. It is a triple ETF, right? So you have to be careful with the triple ETFs in corrective markets. If the market is in a correction, I'm talking about a real correction. I would trade the triples as a trade, But as a long-term hold, no, because when you are in a corrective market, the decay kills you. These ETFs for the long term, it works great after we bottom and we are in the trend. But if we're not trending and we are still in a correction, the decay is going to kill you. So for a trade, if you want to, if you want to buy for a trade, in the hole, market is going down, you think we're going to bounce, then yes, of course. But while we're still in the correction, which we are, you can argue that we are, for a long-term hold, it's a little sketchy because the decay is going to get you. ARC seems to have double support around 105. Right. So, listen, I'm not so sure that when it comes to ARC, I'm not looking at support levels. I'm not looking at anything like that. You're buying the manager. That's what you're doing, because these people trade every single day. So I'm not so sure that just because it has support at 105, it's gonna have support again at 105, because they trade every day. And for all we know, what about if they sell their holdings, and whatever holdings they had back then, they no longer have those holdings now? So I just wouldn't, I don't know if I would use, technical analysis so much in ARC, since they trade every single day. They're buying and selling stuff. Who knows if they might change their allocation to their top holdings. So again, for ARC, what I'm looking to do is, let's say I believe in Kathy Wood, okay? She's and again, what she runs, for the most part, it's a momentum ETF, or she's got the best story stocks or the best growth stocks, mainly story stocks. And if you're and for me, the opportunity arises not when it's up every day, but when it's down. When it's down 30, 40%, because everything's going to go down. Everything goes up and down, not up or down. For me, that's where I see the opportunity. So I wouldn't go too much with the technical analysis on this one. What's your opinion on using this put to call ratio to find the bottom? I don't track the put to call ratio any longer. I used to. I no longer do. It just hasn't. It just hasn't worked the way it did years ago. You have a lot, and the market changes. Indicators, they change as well. Listen, high put to call ratios usually always work. You get a high put reading, that's normally a sign of a bottom, but it's got to be extremely high. I don't know what it is now, but the flip side was, anytime that we got the CBOE equity only put to call ratio at 0.50 or lower, the market always corrected. And that has not been the case lately. I've seen it as low as 0.35. So what you want to do is, you want to do a combination of things, all right? The whole combination of thing is, you want to see on the 30-minute chart, you want to see these moving averages start to flatten out. You want to see them start to curl higher. We want to get back above those levels. If you take a look at the indices, if you look at the QQQs, the 21-day moving average, has been an important average for the QQQs, acted as support for a very long time. You can see it here, the red line here. We're finally below it, right? So if you wanted just to follow a longer or somewhat of an intermediate trend, maybe you say to yourself, hey, I'm not going to look at the market or the QQQs until we get back above that 21-day EMA. So I think it's a combination of things that you need to look at, just not one single indicator. And this over here, this 21 EMA, whenever it is we go back and retest it, that's going to be a big test. And that I think that holds the key to what we're going to do in the intermediate term. Any other questions? As far as all right, because the price ranges are so high, are so wide right now, will you trade less stocks and or maintain lower risk? Right. So because the price ranges are so wide, I'm gonna put on less risk. Uh, and the reason why is because I normally do my trading. The amount of shares that I buy is based on the buy stop and the sell stop. So the wider the stop, the lower the shares I can actually buy. And when I was going through some of these stocks looking for ideas, a lot of them the buy stop is really far away. Like let's say just take APPS, right? This is a name, had a gap higher here, more than likely on earnings. It's down multiple days in a row, my type of setup. But the stock closed at $74 a share, and for me, the buy stop has to be 81.15. Now, if I take this stock and that buy stop is roughly, what is it, $7.25 away, 725 divided by 74, that's 9.8% away. And then if I really wanted to give this stock room and let it prove itself, I'm gonna have to put a stop loss at $66 a share. That's just too wide for the way I do things, for the way I trade. Okay. You can say, look, Friday was significant. Friday, I think, was a low. So I'm gonna buy it here. And I'm not gonna wait until it gets to 81.25, and I'm gonna use this stop. You can do that as well. I'd rather wait for a tighter candle that's going to give me a more of a cleaner, closer exit. So when I go to MP as well, MP, I mean, for me, the way I buy things going through the previous day high is roughly 45.37. I'd rather get my participation on those first couple of days with the index ETF. If I'm inclined to try to play a bounce, I'd rather do it for the most part with the index ETFs or something like ARC or something like the IBD 50, something that I know if the market bounces, I'm going to participate on that bounce. And then after we get that initial bounce, then we're going to get the setups. And that's when the indices will go into some type of consolidation and the individual names will now take over from there. And more than likely, after we get that initial bounce, then the ATR, the average true range in the market, more than likely will start heading down. It'll get lower and lower and lower. Very similar, like for example, what happened here in September. You see here, it rises and then it starts to go down and then things start to settle down a little bit. Okay. Same thing here after the coronavirus. Uh, we had a tremendous spike. And then once it starts to go down, the market had a follow through day. I'm not a big IBD. I don't follow the IBD that much, but after a correction, I do think that you can get a lot out of following their market call once we get that initial follow through day. But that doesn't come in until day 4, and Friday was only day 1. Okay. So I want to play the bounce for the most part, primarily with the indices. And then after they bounce, I want to go to the individual names. Also, with the futures up right now, I'm leery of a gap open. Right, right. So again, um, look, the market is not open every day for us to make money. The market is open every day for us to lose money, right? So, Dan, if this is the Dan, Dan from the room, then you know what it is, what a good market feels like. We seen one. We went through it. You see how stock starts to set up. So you can, if you don't feel comfortable, just take the day off, take the week off, and just allow the market to do whatever it is it's got to do. At some point, just like it does every other, whatever it is, 3 to 6 months after a correction, stocks will start to set up again, and we're going to have a great swing trading market. The key is for you to hold on to that capital and that mental capital, so that way when we finally get the market that uh, that we do well in, then we strike hard. Are you paying any attention to any other ARC ETFs like ARC F, ARC G? No, I'm not. Mainly in the ARC fund. Mainly in the ARKK. That's their main fund. Some of the other ones, they normally hold some of the same stocks in every single fund. Um, let's see here. Thoughts on Peloton. Peloton is, another momentum name that just broke down. Okay. All these moments. Look, the S&P 500 down 2.5%. But the individual names underneath the surface have been decimated. I mean, crushed. Pretty amazing. The rotation underneath the surface, energy names up, whatever it is holding up, propping up, holding up the S&P 500. Whether they're going to catch up or not, it's a different story. But look, Peloton 175 to 170 to 105 in a matter of a month. Yeah, I mean, that's a big downturn. Listen, if you like the stock, if I wanted to trade the stock the way I trade stocks, which is my time frame for most individual trades is 3 to 5 days, I'll take the stock at, going through 107.74 tomorrow. If it does it tomorrow only, buy stop 107.84, sell stop right over here, $94 a share. You can probably get 130. Okay. So that's for Peloton. How do you manage risk buying blood in the ETF like ARK? I'm not managing risk when I'm buying the blood in the ETF like ARK. So when I'm buying, Cameron, when I'm buying the S&P 500 QQQs and IWM, again, the market goes down on average 14 to 15% on average every single year, some years less, some years more, but the average since 1980 is roughly negative 14, 15%, okay? And then over time, the market goes up. So I am looking to buy that blood slowly but surely. I'm buying more. So I'm going to say, look, I don't have any allocation to the S&P 500. I want to get to 10%. So I'm buying 1%, goes lower. I'm buying a little bit more. I'm buying a little bit more. I'm buying a little bit more. My time frame is forever. So with the ARK ETF, I bought a little. I'm hoping it goes even lower so I can buy more. I believe in what it is that they do. I believe in what it is that she does, and I want to put money behind her, not after a move has already happened. I want to do it on the way down because everything goes up and down, not up or down. It doesn't matter who you are. You can be the best Peter Lynch, Ken Hebner, whatever the case may be. These guys all had ups and downs, ups and downs. You're not going to have the Midas touch every single day for 7 years in a row. It just doesn't happen that way. But if you believe in what it is that they do, then you want to put your money with them. They're in the down years. They're in the down months. They're in the consolidation period. So when whatever it is that they do finally comes back in favor, you're already in there. You're not waiting for it to have a tremendous move and then say, oh my God, they're the best again. Let me go back in now after they went up 80%. You don't want to do that. All right, let's see here. How much does your account risk size per trade on individual names change? Example, from when you say you're moving pawns to when you get on a winning streak and really start to go big, is that 4 times? Okay, so that's a good question, right? So when I'm moving pawns, let me give you an example. When I'm moving pawns, I'm moving very small amount. Nowadays, for the first time, I don't check. Number one, I don't trade my P&L, but I do track the performance of the NAV on a weekly basis because now I actually put moving averages around my net asset value to see if there's any. I want to see if there's anything there. Like for example, should I hit the brakes if my NAV is underneath the 10-day moving average or the 21-day moving average? So I'm just just playing around with it. But when I say I'm moving pawns, let's say, for example, that if I put 3% on average on every single trade that I take, when I say I'm moving pawns, then that size is going to go down to 0.5% or 1%. It's going to be small. Okay. Let's say if my normal risk on a $100,000 account, let's say it's $500, right, per trade, I'm going to take that down to 100. And that's the reason why recently, although I had 7,000 losers over the last month, my actual win-loss ratio went up because the losses have been so small that it actually increased my win-loss ratio. And whenever it is we have a market turn, right, and I go back to trading my regular size, then that little downturn, that little blip will more than likely be gone in 1 week after 1 week of gains. So I am reducing size, okay? Reducing size until things change. So again, so if I put hypothetically, if I risk $500 per a $100,000 account, I'm taking that risk down to $100. If I normally put 3% behind ideas across the board, I'm going down to 1%. Are you suggesting it's too early to get back in the market now? That depends on your time frame, right? Let's say, for example, that you're 21 years old, you're 30 years old, you got your life ahead of you. It's never too early. You can get in now because you have your whole life ahead of you, especially if you're only involved in the S&P 500 or the NASDAQ 100, the index ETFs. You have time. That's the most valuable thing that you have right now. If you're young, you have time. From a trading perspective, the way I trade individual names, you're always going to have you're always going to have ideas, trade ideas. Whether this is a time for me, the way I trade to put on regular risk, no. This is a time right now, like someone just said, I'm moving pawns around. Things can change very quickly. Things can change this week. If I start seeing setups and they start working, I'm increasing size immediately, okay? But as far as buying the indices for the long term, if you're young, and you believe in dollar cost averaging, it's never too early, it's never too late. What's your opinion about Labo and Nail? They're both are ETFs and did well on Friday, right? So again, it all depends what your time frame is, right? So if you believe in these two, if you believe in LABU, and you like the biotech sector, and you believe that SoftBank said, hey, we're going to spend X amount of money buying biotechs, and you believe in this sector, and you believe that Friday was a significant bottom, a significant day, then you buy LABU and you put a stop at 70.33. That's simple. You put a stop at 70.33. If we violate Friday's low, then we're probably going much lower. The same thing with Nail, right? That's from a trading perspective. That's the way I would do it. I would use Friday as a key level, those lows, that if we break those lows, we're probably going lower. If you believe in inflation, when you start accumulating GDX here. I'm going to pass on that one. Okay. We've been talking about inflation. They've been talking about inflation for the last month or so. And GDX has done nothing at all yet. Gold just, I think, hit a new low over the week. Again, they've been talking about inflation for the last month or so. We're going to get inflation. I mean, that's just a given that we're going to get it based on last year's numbers. Gold is not reacting to it yet. But I'm going to pass on that. What is your typical drawdown? I don't know. Depends. But my drawdowns tend to be very small in general. All right. Any other questions? So here's a setup, right? Run, not a bad looking setup. It's down multiple days in a row. The buy stop is not that far away, $2 away. But the sell stop, if you really wanted to give it room, you're going to have to go out there and put it at 46.88. So you have a lot of stocks down multiple days in a row that are going to be candidates for tomorrow. It's just a matter of finding some where the buy stop is not that far away. And the sell stop is not that far away. RKT is one that I anticipated on Friday, bought it at 24.49. Stop loss at 23.48. That's $1 away. That's not bad at all. So for tomorrow, those in the room, what you want to focus on are the stocks down 3 days in a row or more. And we had 1,365 on Friday. And today we have 553 names. This is where you want to look. This one doesn't look so bad. Down 4 days in a row. Buy stop 31.87. Sell stop 29.30. Not bad at all. What you want is hopefully the futures I think are up right now. Hopefully they reverse. We open flat to down, and that'll be easier for you to put orders in because no one likes to really start chasing at the open. And I'm not going to chase at the open. But this is the list that you want to focus on, the down 3 days in a row. And there's a reason why. Sol has been annihilated. Are you keeping an eye on Sol? Yeah, so I don't keep an eye, in all stocks, but this will come up on the down 3 days in a row. Here it is. It comes up right here. Comes up right over here. And again, it's a setup that is from a scan that if you study the best performing stocks in a short-term basis, you're going to realize that what matters the most in the short term is momentum and mean reversion. And this is a mean reversion type setup where it's down multiple days in a row. Okay. And in a situation like this, the buy stop is the problem. The buy stop is 1193, right? I mean, 1203, at least for me. The stock closed at 1084 minus 1203. That is roughly 11% away. That's too far for me. Okay. And what ends up happening is when you have these big wide ranges, what ends up happening is that chances are that we're going to get a whole bunch of inside days on Monday. And then you get a much tighter candle that's going to give you a buy stop that's a lot closer and a sell stop that's closer as well. Yes, listen, I'm going to go through all these stocks. I'm going to go through the top 400. The top 400 in the Russell 1000, which very simply is the top best performing stocks on a 6-month basis, 3-month basis, a 1-year basis, and a year-to-date basis. You take the top 100 stocks under those time frames, you put it on the list, and that is probably the best list to find the best performing stocks over the next couple of weeks. More than likely is going to come from that scan where you're looking at the best performing stocks on a 3-month basis, 6 months basis, 12-month basis, and a year-to-date basis. You can do that with the Russell 1000 names if you need higher price stocks, if you need liquidity. If you want to look at all names, then you look at all stocks in the universe, and then you're able to find the stocks with the highest momentum, which are more than likely the ones that are going to perform the best in the short term. Let's see here. What else do we have here? Would you repeat the formula to decide the buy price? For me, this is the way I trade. The way I trade is that 99.8% of what it is that I do, I'm buying through the previous day high. That's it. So let's just take, for example, SOL. If I wanted to get involved in this stock, my buy stop is going to be 10 cents above this high, which is 1193. It will be 1203. With this particular setup where the stock is down multiple days in a row, stocks that are down multiple days in a row, 3, 4, 5, 6 days, they tend to outperform the indices 1 week later, which is the opposite of what you read about in the books. People want to chase stocks on the way up. But the fact of the matter is, if you actually do the studies have shown that stocks that are down multiple days in a row, 3, 4, 5 days, outperform going forward in the short term. Now, the reason why I don't like to buy on the way down and I want to buy after it goes to the previous day high is because, again, 2 days can turn into 3 days, 3 into 4, 4 into 5, 5 into 6. So I'd rather wait for that pattern, which is very simply what the pattern that you have here is a pattern of lower highs and lower lows. And what you're waiting for is a change of that pattern by printing a higher high. Okay. What do you use the trend intensity column? The trend intensity column, that's something that's an indicator from Stockbee. And very simply what it is, that is the same thing as a 3-month momentum. It just gives you, it ranks the stocks based on momentum in the last 3 months. So if you had a watch list US stocks, let's say, for example, US stocks, and you went to recent performance, that trend intensity is exactly this, the best performance stock in a 3-month basis. So that's just the best performance stocks in a 3-month basis. That's all that means. If it was, for example, for a quarter, half a year, it'll be 126. If it's 1 year, it'll be 252 days. So that's what that means. Any other question? Awesome. Added some run on Friday. RUN. Again, nothing wrong with that run, right? So here's another setup, just like SOL. Down multiple days in a row, it prints a hammer. For me, the buy stop would be 54.48, right? The buy stop would be 10 cents above Friday's highs, 54.58. And the sell stop, if I wanted to give it room and Friday was a significant low, you got to go initial sell stop 46.88. Or you can do a combination in a situation like this where you have run this purple line right here is a 200-day moving average. You can do a combination where if you buy 1,000 shares, maybe you put a stop loss on 500 at Friday's low, 46.88, and then the other 500 here at 51.68, because you might say to yourself, look, that's the 200-day. If this stock can't stay above the 200-day after it goes to the previous day high, then I don't want to own it. So maybe you do a combination of sell orders, of stop orders. Any other questions? All right, guys. Thanks for taking some time to watch this little meeting. And for the guys in the Stock Twitch room, you already have the top 400 list. You already have the top 400, 1,000 list. And again, I think the focus, at least the next couple of days, should be the stocks down multiple days in a row. I think that's where you're going to have the opportunity. That and also stocks that printed an inside day, because more than likely you're going to see a lot of this down 1, 2, 3, 4, 5, 6 days in a row, and there's the inside day. So it's pretty much the same. It's a combination of this. It's pretty much the same thing. But that's what you're going to see probably more than likely on tomorrow. I mean, on Tuesday, here, inside day. And that might give you a better risk reward trade.